Okay, this is the Edge demo for January 5th, 2023. Good to see everybody. And so right off the bat, I want to get to this question about the math. You know, people will send me notes and say, what's the process? Well, I hope that I've done some reasonable job at explaining that I think is a fairly simple process. I was having this exchange with somebody earlier, and I'm going to share my screen here. Let's see, screen. There we go. Sorry, you're going to hear some clicking because this isn't my normal machine. Okay, get rid of that. To me, the process is very simple. There are three things that I repeat over and over. I've made 20 plus trades today. If there are things that achieve the return I'm after, I'm out and I'm going to do something else. If I think the math has told me, there it is again, the math has said you should leave, then I'm going to do that. And I'll certainly use what I know about how the market works to facilitate that. But I'm not sitting around thinking about it. I think of broad sentiment is money coming into or out of the market, as we can see in the broad picture, and you can see my screen here. So by broad, that's what I mean here. You know, is this rising or falling? Is it above the red line or below the green line? Where is it? I'm going to look at that every day. And I look at the supply side. Look, it's not great, right? The demand side has risen, but the supply side has too. Makes it very difficult to get gains from the broad market. There's no question. The market is up from its, where it bottomed. Right here where supply was at its nadir and demand began to rise. Well, the market did, but it's just not been very good because of the excess supply. That's one thing. Context is the second thing. I'm always thinking about what's on the calendar. Let me, if I can here, let me open a browser and just point this out. This is what I mean. Hopefully you can see my screen. And if you ever wonder what the context is, you can go over here to Edge and just look at the calendar, the expirations calendar. It's not the only thing. I mean, I certainly pay attention to things like the jobs data that is coming on Friday. And of course, there was ADP data, which is really better data, frankly, than sometimes what the government puts out. I don't fixate on it, but I'm certainly going to be aware. And then I'm going to look at the expirations dates. So for January, they're the 18th, 19th, and 20th. 16th is a holiday. So I'm going to be aware that those things are going on, and then trade divergence. So to me, the math then is we have these portfolios that we create for you. You can do your own iterations of them. There's momentum and there's low volatility. To me, those are the two things that at all times, there are different ways to think about them, but that's what you're going to trade. When money's coming into the market, well, can we trade things that are likely to produce a better return? If money isn't coming into the market, are there things that everybody's going to cluster in to try to ride out whatever's coming? And can we benefit from that? And one of the two is most of the time going to show us what those are. By momentum, I simply mean there is excess demand and insufficient supply. And then preferably there would be some volatility. One of the core things I have on my list to talk about, I mentioned how volatility had vanished from the market. It can vanish and suddenly reappear. That it's very much in keeping with how the market works. But if I click through here and look at the one thing today mathematically that you could look at and say, is it great? Well, it's not awesome, but tenant healthcare, a little small. It's $5.5 billion in market cap, barely gets you into the Russell 1000, the 1,000 largest stocks. But this is volatility. If it moves, some portion of that up or down, that's our expectation. Our expectation is there's the possibility of producing a 3 to 4% return in THC, and it's defying the market today. I picked one. I'm going to pick something. I picked MCD. I bought McDonald's. Interestingly, the spread was higher in that than it is in this, which is just crazy, right? But it's It's interest that tells you where the market makers felt like they could get the better return. But that's and volatility in the broad market has averaged. If you look at the S&P 500 and add up the 500 stocks and their intraday movement, that's volatility, and then divide it by 500-ish, it's been running till December close to 3%, believe it or not. And so that gave us a lot. Every time the money came into the market, it gave us a lot of volatility trades, and it would show up in the math. You could just run that automated sort that would look for things with diverging supply and demand and volatility of 3% or more, and we could get a bunch of those. Well, they've been hard to find here lately, and it's because volatility went out of the market. And volatility is nothing more than changing prices. That's what it is. And as trade sizes shrink and machines sit in the middle and try to take 1/10 of a penny and then change the price. I looked at my trades today. There were routine times when my 99 share trade, I sold a bunch of Halliburton, would get chopped into tiny little pieces. And every time somebody can sit in there and if a trade that should be one trade becomes 6, there are 6 different opportunities for somebody to make 1/10 of a penny at a different price. Well, that's volatility. And the market is incredibly unstable. The market trades call it, 10, 12 billion shares a day, dollar volume of $400 billion a day, and the average trade size is 100 shares. Well, it's like you have this massive amount of stuff that has to move through a tiny little tube. And that's why prices change all the time. Who knows which side the supply and the demand are in between that tiny little tube of 100 share increments? Well, fast traders do. Which brings me to this little point that I had alluded to earlier, where one of the questions I got from somebody was, well, what's your method? And I said, in response, it's pretty simple: supply and demand around broad sentiment, context, and divergence. And there will always be something to trade. Sometimes it's a paucity, and when it is, then the data are cautioning us, and it's been correct. But this tool reflects reality, reflects all that stuff. You look at the technical indicators, and I'm not knocking them, but I'm saying that most of them are my age. Technical indicators, by and large, are 50 years old. Well, the stock market is nothing like what it was 50 years ago, not even 20 years ago. If you think about, and I'll give you a little history here, the stock market could be traced back to a pleasant mid-May day in 1792 when 24 brokers got together under a buttonwood tree in lower New York City and agreed to give each other preference and to charge a minimum commission. Those were the 2 sentences of the Buttonwood Agreement that formed what became the New York Stock Exchange. And it's that worked great for 200 years. I mean, it's not perfect. There were people in the middle making money, nothing like they are today. But it's important to understand that lesson. There was a minimum commission. That's where the term $2 broker comes from. They became, you charged a $2 commission. And you would say, well, let me check with the group before I look somewhere else to find a buyer or seller. And today's stock market caps the fee. It's the opposite. You can charge a maximum, and in the stock market, it's 30 cents a 100. That's the maximum amount that an exchange can charge for a trade, and most of the time they're paying somebody for a trade. And they cannot give preference. An order can go to any market. If you're trading at the NYSE, you have no obligation to look first at the NYSE. You can send it to the NASDAQ or the CBOE, or they're technically 18, but 17 that are operative, 17 different stock exchange platforms that can match trades. And I won't take you down through all of that, but that's how the market worked until roughly 2001, when decimalization was implemented by regulators changing the gap, the spread between the buyers and sellers to a penny-ish, that was a major change because it said that the data that used to belong to the exchanges now belong to everybody. In fact, there were property rights challenges to it. But it changed the whole intermediary role. And then in 2007, after an approval in 2005, the SEC implemented what is called Regulation National Market System, linking all of the markets together around a core set of rules so there really is no competitive differentiation. It's not that the NASDAQ has an advantage over the NYSE. They're all part of the NMS, the National Market System. So I think it's important to know that. Well, all the technical indicators were created for a market that no longer exists, where things traded at the NYSE that were listed there, 100% of it, or at the NASDAQ if you were listed at the NASDAQ. And behavior in the market was principally investment behavior, not intermediation. And so it's important to know that's what if you're using technical indicators by themselves and you find it's difficult to get them to work, it's because they don't reflect the architecture of the market today. So I wanted to describe that because I think it's important. Realize that you don't want to be using 50-year-old tools in a market that has changed dramatically. And I hope that you're having success doing this. Look, I do the same thing I just do what I share with you guys. And I can't spend much time on it, maybe 30 minutes a day, but it works. Okay. I want to make sure I'm not missing anything here. Bear with me 1 second. Again, this is not my usual machine for these purposes. Any questions? Just fire away before I leave this topic. Steve, good to see you.
Thanks. Good to see you.
Barry, good to see you. Okay, then if there's okay, then I'm going to go on to the next thing on my list here. So does that make sense? When I say the math, that's what I'm referring to. The math is the stuff here. I'm going to, I'm going to look at momentum and low volatility. And I've watched, momentum has been, there's nothing there because it depends on volatility. If volatility goes away, it becomes difficult for intermediaries to price stocks. So this brings me to this item. I mentioned it in a market desk note about ETFs, that I think part of the reason that volatility has diminished in the market, and it can show up suddenly, that's what I would expect, by the way, that the cause of that was a bunch of year-end movement, either of baskets of stocks to the BlackRocks and Vanguards and State Streets of the world in exchange for baskets of ETFs, or vice versa. Could be either way. And how would you know which way it's going? Well, there are some ways you can surmise, and I think that demand can be a key piece of that, to supply and demand. But how that happens, this is just a survey because it's a long topic, but it's the only way for supply and demand to avoid the stock market. That is, if a large hedge fund, let's say, takes a basket of stocks, a portfolio, and goes to Morgan Stanley and says, I would like to trade these stocks out for a basket of of BlackRock's total market ETF. That transaction occurs off the stock market because it's like a real estate like kind exchange. Here's $100 million of stocks, and I get $100 million of the ETF. And now both parties own those things. And so BlackRock owns $100 million of stock intermediated by Morgan Stanley as the what's called authorized participant. And now the hedge fund has a bunch of ETF shares, which are very liquid, very easy to move. And why would you do that? Well, if you think, well, I'm not sure how the year is going to start, that's what happens. Well, what happens in that process, because there's no price change and all that flow isn't on the stock market, is a spread narrows. And when spreads narrow, how do you set prices? For a Citadel, you want some volatility. How do I know whether to buy an ETF and sell the underlying stocks or vice versa? Or how do I know whether to trade consumer staples long and tech stocks short? All of that stuff is occurring in the market. Well, I think that that's what happened. And what happens as a result of that, as spreads narrow, is the amount of price setting by the machines that maintain this highly fragmented, but I mean somewhat stable market diminishes. So what tends to follow periods of low volatility and higher supply is a sudden lurch. And I'm not saying that's going to happen, but we saw a little taste of it just today, where before the ADP jobs data came out, pre-market, so that's all driven by futures, not by actual stocks, that very tiny smatterings of them through dark pools, that the market turned around, and that is a product of uncertainty for machines on how to set prices. So then you would say, well, of what consequence is that to us as traders? Well, it's important stuff to know. It helps us make good decisions. If we look at the momentum portfolio, which is looking for stuff and it was wrong. Thanks for some of you sent me notes too and said, hey, it's given us stuff that is less than 3% volatile, and we fixed that. That if nothing shows up in here, that's the trouble, and it should make us cautious. So what I tend to do then is look and say, well, are there momentum up? You can trade them. Steve, you sent me a note. You wisely probably bought and sold it. HAL, I owned a bunch of HAL, at least for my trading account, 700 shares of it, and I sold. I didn't, I was hoping for 2% or more. I took the 1% I got, but I looked at this data this morning, and I won't lose my train of thought. I looked at this and said, well, so I'm going to leave today because the demand side has changed. I mean, it's still well over 5. Could I stick in this? Well, sure. But any change on the supplier demand side is going to be my signal. And so I sold it today, and I'm selling it at the market in tiny pieces. Got all my prices were within a penny of each other by doing that. No change on the supply side. It was all on the demand side, a decline in demand. And I know, Steve, that you traded that successfully. Back to the point, when there are limited volatility opportunities, I'm then going to go look at low volatility. It's opposite. And as that number grows, it tells you, again, market structure is a feedback mechanism about what everybody thinks and does, no matter what their purpose or time horizon. And this is what you could see. Well, big drop on the supply side. If you look at the averages for the group, demand right at 5, I'd look at that and say, well, that money is starting to go there. And you could look across them and say, well, Inky's pretty good. It is. And somebody sent me a note about that. Why would you pick MCD over Inky? And only because of size. This is 18 billion in market cap. This is 195 billion. But they have similar characteristics here. One it rose to 5, the other one dropped to 5. There's that slight difference. But I looked at this and thought, well, I mean, this big tailing off on the supply side ahead of things that have become very important to the market because we're fixated on what the Federal Reserve does, jobs data, well, that's where the money's going. So the money thinks it could be volatile. Now, it could be volatile to the upside, could be to the downside. But that's what prompted me to say, well, out of that, I'm certainly I'll take MCD, and I'm not after much. If you're concerned, and I don't necessarily do this, I don't do it very often. You can put in stops and limits at your levels if you want. I don't like to do it because I miss out on returns, but it is the safer thing. I understand that. But I look at this and say, well, this is where money is going very short term here. The whole thing could change by next week. The market is constantly changing, and it's a function of the very short horizons that exist today. Okay. Questions, comments, observations? Nothing. Okay, well then.
This is Dan.
Hey, Dan, good to see you.
So MCD, good to see you. Thanks for answering my question.
You
So
bet.
I'm looking
Sorry,
at
it takes me
MC.
time.
I'm looking at MCD right now, and it opened. It's been dropping since the opening.
Mm-hmm.
So can you walk us through what your approach would be in buying and selling that?
Yeah, and I didn't buy it at the open by any stretch. I waited till it had gone down its full volatility. And I could look to say, I don't care where I am in it today per se. Let me see if I can tell. No, I don't have it open. So my thinking was that simple. Let me go over to the app. I look at the volatility. So it's 1.4%. If it goes down that much, I'm buying it. And it did. In fact, it went down a little more than that, right? So I forget what price I bought it at. 261 and something, I think, is where I bought it. And so that's the thinking process. If it's going to be down, if the market's down and it's down its volatility, what is the probability that tomorrow is worse? Well, there's certainly some probability that it is. But the probability that a stock like this, where money will likely go, there are all these models that are going to run the calculation saying, well, if the market is 2.5 or 3% volatile, I want to find something half that volatile ahead of data that could affect the market. I think the probability is fairly high that sometime between now and before the jobs data are reported Friday, that one could get or tomorrow, that one could get a return on that. So that's my hope. That's the thinking process. And I shouldn't use the word hope. It's not hope. I'm taking this math at face value and saying the probability is this stock will outperform the market if it's down. And now we'll see.
Hey, Tim, on your comment on, I think it was on Tuesday, on your market note, you talk about volatility as essential ingredient arbitrage and so forth. And you said, in fact, all ETFs depend for prices on price difference in arbitrage. Yep. Can you explain that a little bit more? So what does that mean? I usually think of arbitrage as buying in one basket and the other basket reflects what you just bought, and you can sell at the difference between the two or something. Can you explain that a little bit more? I'm not real firm on that.
So ETF shares have no intrinsic value. They're like a currency. They don't reflect a claim on an underlying basket of assets. If you own a conventional mutual fund, the mutual fund can only give you one price per day because all of the participants in the fund are effectively shareholders who are entitled to the same price every day as everybody else. So ETFs are marketed as mutual funds that trade like stocks. There's no such thing. That's not possible. It would be a violation of property rights laws. So it is a substitute. So it's like saying, here is the pool of assets, but we're going to trade this thing that is a receipt tied to the value of the underlying assets. But the receipt itself has no value. And the ETFs were created by commodities traders who said, could we trade a warehouse receipt instead of the moving grain or gold or what have you? So that's what happened. ETFs then trade like stocks because there are no customer accounts associated with them. If you buy a BlackRock ETF, BlackRock has no customer account for you because BlackRock has no fiduciary duty to you. Your shares reside in your brokerage account. And so therefore, they're worth only what someone else is willing to pay for them. And he said, well, that's kind of scary. Well, it's the same with a derivative. They are a derivative. And I'm not saying that they're dangerous by any means. There are ones that are. But so then how are they priced? Well, because there's a mechanism at what's called the Depository Trust and Clearing Corp that publishes the basket to a set of authorized participants every day who will know, okay, the value of this ETF ties to this basket of stocks. So if the ETF is currently priced more than the underlying basket, then I'm going to buy the basket and short the ETF, and vice versa. So it's doing exactly what you said, Barry. But the way that a market maker determines whether to make a market in something is the arbitrage opportunity. If that spread narrows to a tenth of a penny, a market maker is not going to. Why would you make a market? I can't make any money on that. And that's when trouble develops. If a market maker says, I don't know whether to be long or short this thing, and I got a little concerned about SPY versus S&P, the S&P 500 stocks, because you could look at SPY, which you can see at Edge, and say, well, their short volumes are almost identical, and so is their demand. Well, then which thing would you buy or sell? Those conditions tend to precede drops in the market, because the market makers who are responsible for 85 or 90% of the volume go, well, I think I'm just going to go trade treasuries instead. And boom, the market takes a hit. That's what can happen. And it doesn't mean it will, but it's important to know that there are only a handful of firms are actually making markets in those securities. And so I think that that's very important to know. You know, it's important to watch volatility. Volatility vanishes, not a good thing. That's why I'm not a huge fan of the VIX. I think the VIX is a lousy leading indicator. If anything, if the VIX declines, it's worse because it's telling us volatility is coming out and everybody's arriving at the same price. That's how I think about it, Barry.
Thanks. I appreciate that.
Yep. Let's see. Then we're just down to examples. I mean, I didn't get to all these questions that I thought were really good questions that deserved answers, but we can save it. Yeah, Steve.
SPG?
Yeah, SPG. So, and are you for or against it?
Oh, I bought into it.
Right, and it defies logic. Right? I think, well, you know, why would you, if in a recessionary environment, buy Simon Property Group, a giant mall owner?
Right.
Well, it's where the money's going, right? You look at that. I mean, you've got this awesome bedrock 5.0 demand, and all of a sudden supply plunges. Well, what's the price likely to do? Well, you've done it just right. Very probable, and it's been sitting there, hasn't it? It's been sitting in the low volatility portfolio for a number of days, telling us that's probably a pretty good place to be. And it's a classic example of the trouble with bottom-up analysis in a short-term market. I could give you all the reasons in the world why SPG is a terrible thing to buy, but the data tell us otherwise. And what do we care? All we care is that we buy something and sell it at a better price. And if the math is in our favor, that's all that really matters. And it's very liquid. It's very large. It's one of the largest REITs. So that's a great place to be in markets like this. Good one, Steve.
It crashed today.
Of course it did. That's too much of a move. It moved way more than its intraday volatility.
Yeah,
that's a dangerous signal, right?
I bought it at its low today. So
perfect. Yeah, the probability
way over its volatility. Like
there you go. And again, that's all you're using. If you know, Steve's a very good user, and you can really learn from him about this. That if something like SPG, generally, we're running a 5-day running calculation of volatility because things change. You don't want too much trailing data because everything changes. Where the money is, how things are being priced, that's continuously changing. And it's better to be at the front end than doing years of analysis trying to figure out how a price is going to behave. What happened a year ago is not a good indicator of what will happen now. But look at SPG. So, you know, it averages, that is affected by yesterday's volatility. If you backed up a day, it's, you know, which you can do. You know, you can go do that by doing that. You know, if you change your time frame in the graph, you can do a custom time frame and look at any period to see. But
that will change, show the volatility.
Well, I don't know if it will. I don't know that it will. You're probably right about that.
That would
probably
be
won't
fabulous.
change that. It'll only change the graph. Yeah.
Okay.
But this is what we're talking about. There's your, you know, if something goes down that much and it's got stable demand and falling supply, the probability, all other things being equal, that you can make that much is pretty high. And that's what you're after. In low volatility,
went down 4%.
4% is, I mean, it's a huge opportunity. Again, all other things being equal. I still would say, you know, what will the market do with jobs data tomorrow? We don't know what it's going to be. If you know, I have speculated that we're going to get a weak jobs number, which temporarily would be good for the market, not good for the economy. I don't think it's coming tomorrow. I think it's in February, but you never know. And so what do you do? Those are things that can't be known. That what can be known is supply and demand. That's, you know, the rest is speculative, but very good chance. So where I was going with that is, boy, if you have a 2% gain in that tomorrow before the jobs data come out, I would take that, right? And it's better to take the gain because we don't know what the market's going to do when that jobs data comes out.
Already did it.
There you go. Yeah. There you go.
Tim, can I ask you a question in regards to volatility?
Absolutely.
Hi, this is Jimmy.
Jimmy,
Nice to meet you as well. So listening to what Steve said, it sounds like he used the yesterday's close to then determine how far down SPG went. And so then it went 4%. But so when we're looking at volatility, are we pegging it to the close of yesterday or the opening of today?
It pegs off the close yesterday. We're always thinking about close to close. And you'd say, well, why would you do that? Well, because that's how all models will incorporate the data. That's what everything's going to do. The reference price for anybody who needs to be at the benchmark will be the closing price.
Gotcha. Okay. Thank you for the clarification.
Yeah. That's what I'll look at too. So I'm looking at how much does it open, where does it open versus the closing price? What else? I was a little bit late, so I'm going a little bit longer than normal. And rather than get into the next topic, let's just do this. Any examples we want to look at?
How about Merck? They said that they hit an all-time high today. On my screener, anyhow.
Okay.
So they got a pretty good bounce. So
I mean, again, it's a great stock, and you say, well, why isn't that showing up in low volatility, which it routinely does? And it will be maybe it's 1 day short of the total days at 5 out of the trailing 30. That's what the model is looking for. But that's it's terrific. Solid demand, falling supply. It's true. Yeah, I mean, that's a great low volatility stock.
Tim?
Yes.
Is there any way that it is possible to do without us having to do it, but to get an average of volatility over a 5-day period?
That is that number. It's a
That
5-day
is 5
average.
days.
Yep.
So it's not from the close. I just heard you say, and I must have been mistaken, that it was the close of the day of 2 days ago to the yesterday, but it's actually a 5-day, right?
It's taking my apologies for the confusion. We peg, if we're calculating volatility, we're calculating it close to close, but then we're taking a 5-day average for that data point. And
okay.
There are many data points that we process behind the scenes, 5, 20, 50, 200. We're looking at all kinds of stuff, but because we're using this platform for a short horizon, that's what we use, 5-day. Okay. And by the way, that's one of the things somebody asked, and who said they used NVIDIA as an example. So how come if demand is rising and supply is falling, how come it goes down at all? It said, well, it's there. And we were talking about a period right here, right about the 19th. And I said, well, remember, there are 3 big rules. There's broad sentiment. What was the broad sentiment doing there? Peaked and falling. Context, options, expirations, and month end to boot. And then supply demand. divergence. There definitely was divergence there, but during options expirations, particularly at year end, wow, I just don't like it. I will very rarely trade during those periods of time. But, he said, well, if it moves 5%, isn't that a good opportunity? Just remember, context matters. And it hasn't, here was the best time. This was probably the best time to buy NVIDIA. There would be no interference from those forces early in the month, way out ahead of options expirations. The moment that the supply begins to rise or demand begins to fall, just take the money and run, go on to something else. And I know you're more nuanced than that, Steve Hicks, but that's what I'll do. I'll look once a day, and if I see those conditions have changed, then I'm looking to leave, and vice versa. Okay, what last thing? We got one last thing.
But the supply, how do you weight this? Supply, the supply being below trend or below 50%? Which do you think is more important?
But for our purposes, well, and we've done a fair amount of analysis of that, and then I looked at it anecdotally. For instance, I compared MPC with HAL, Marathon Petroleum, Halliburton, two energy plays. Marathon Petroleum had a nice supply-demand divergence, but it was above 50% short. Didn't perform as well. There's no question that if over half of the volume, trading volume, and for you new folks, that short volume is the amount of stock that is trading that's coming from borrowed stock, whether it's borrowed by somebody who expects it to go down or a market maker. Market makers are responsible for over 90% of that. So I would say, Barry, I'd still prefer something that is below 50%. It just increases your odds, right? That's all. But if I weighted them, yeah, I'd weight that. And if there's that's how I would pick it. I'd prefer that. All right, enough for today. I got a lot more material, but 35 minutes of market structure is just about enough for 1 week. So I will look forward to, I've got to make a quick trip to Austin, but I'll be back in time for next Thursday's demo. So I'll look forward to seeing you guys then. Enjoy the rest of the week. Good to see you.
Thanks, Tim.
Thank you guys. Let me kill the recording.